This lesson explains how the setup of the goods receipt affects the GL account postings. Entering a goods receipt is relatively simple. You select the app, enter the purchase order number, select the line to be goods receipted, and click on Post. You can also enter delivery information in the note or delivery note field, or change the quantities. The layout in the GUI transaction code, MAGO, is slightly different, but you still enter the same fields. You can open the material document by clicking on Open in Material Documents Overview. This slide shows the material document in the Material Documents Overview app. In this case, you only see the last purchase order in the material document because the goods receipt was non-valuated. If it had been valuated, there would also be accounting documents. In the next slide, I'll explain the differences between valuated and non-valuated goods receipts. You may have heard of the term three-way match in relation to procurement. This basically means that if the purchase order, goods receipt, and invoice match, or if the difference is within an allowed tolerance, the invoice can be paid in the automatic payment run when the invoice becomes due for payment. If the invoice is for an amount that is higher than the amount approved on the purchase order, or if the quantity on the invoice is greater than on the goods receipt, then the invoice will be blocked for payment. With a valuated goods receipt, the purchase is accrued by debiting the asset and crediting the GRIR account with the amount from the purchase order. If non-valuated, then no posting to the GL is made. The GRIR account stands for goods received versus invoices received, and generally represents accruals, in other words, items that have been received and not yet invoiced, but it can on occasion be the other way round. If the invoice comes in at a different price to the goods receipt posting, as long as the quantity agrees, the difference will be added or deducted from the asset. If you have multiple ledgers, the technical clearing account will be used to achieve this. In the example in the slide, the invoice was $200 more than the original purchase order and goods receipt. Assuming this price difference is acceptable, or if you have to post the invoice anyway because a credit note will be posted, the difference of $200 will be posted to the technical clearing account in the operating posting, and then valuation postings will be made between the technical clearing account and the asset. If the country regulations prevent capitalisation until the invoice has been posted, you may not want the value to be posted to the asset when the goods receipt is posted. Having a non-valuated goods receipt rather than no goods receipt at all means that the three-way match is still carried out, so the invoice cannot be paid until the goods are received. It's also technically possible to have no goods receipt at all, and just a two-way match. But it means that you risk paying for goods that you've not received unless you add an extra step somewhere to check this. The invoice will still be blocked if the amount exceeds the amount approved in the purchase order. And if you have more than one ledger, you'll still need operating and valuating documents to post between the vendor and technical account, and then between the technical account and the fixed asset.